Welcome to our comprehensive analysis of the NZD/CHF currency pair for the period of October 13th through 18th, 2025. In this video, we'll examine the technical and fundamental factors driving this pair to multi-year lows, explore key trading levels, and provide actionable strategies for both short-term and medium-term traders. We'll analyze data from multiple authoritative sources, including TradingView, Investing.com, and Daily Forex, to give you a complete picture of the market dynamics. Whether you're a day trader or swing trader, this analysis will help you navigate the current volatile environment with confidence. Let's dive into the details. The NZD/CHF pair is currently trading at 0.4548 Swiss francs, perilously close to its 52-week low of 0.4502. This represents a significant decline from the 52-week high of 0.5268, marking a year-to-date loss of 10.34% and a one-year decline of 13.33%. The daily trading range has narrowed to just 0.4535 to 0.4556, indicating consolidation near critical support levels. This downward trajectory reflects a classic risk-off market environment where investors are fleeing higher-yielding commodity currencies like the New Zealand dollar in favor of traditional safe havens. The chart clearly shows a sustained downtrend pattern with lower highs and lower lows, confirming the bearish momentum that has dominated this pair throughout 2025. From a technical perspective, the NZD/CHF pair is showing extreme oversold conditions that warrant attention. The 14-day relative strength index has plunged to 20.19, well below the traditional oversold threshold of 30. Even more striking, the 14-day stochastic oscillator sits at just 6.68, indicating the pair is in deeply oversold territory. Additionally, price action is trading significantly below both the 20-day moving average at 0.4603 and the 200-day moving average at 0.4840, confirming the strong bearish trend across all time frames. The technical consensus from daily, weekly, and monthly charts all point to a strong sell signal. However, these extreme oversold readings also suggest that a short-term corrective bounce could materialize at any moment. Understanding key support and resistance levels is crucial for effective trading. The current pivot point sits at 0.4543, serving as our central reference. Above this level, we have resistance at R1, 0.4557, R2, 0.4567, and R3, 0.4581. These levels represent potential profit-taking zones for short positions or entry points for counter-trend long positions. Below the pivot, support levels are found at S1, 0.4533, S2, 0.4518, and critically, S3 at 0.4509. This S3 level is particularly important as it sits just above the 52-week low and represents the last line of defense before a potential breakdown. A decisive break below 0.4509 could trigger stop-loss cascades and accelerate the downward momentum significantly. The New Zealand dollar faces significant headwinds from multiple fundamental factors. On October 8th, the Reserve Bank of New Zealand delivered a substantial 50 basis point rate cut, bringing the official cash rate down to 2.50%. This aggressive move was accompanied by dovish forward guidance, with markets now pricing in further cuts at the November 26th meeting. The economic backdrop supporting this dovish stance includes weak GDP data, with Q2 GDP falling 0.9% quarter-over-quarter and 0.6% year-over-year. Furthermore, the RBNZ announced it would ease loan-to-value ratio restrictions, signaling a clear accommodative policy stance aimed at supporting the struggling economy. These factors collectively weigh heavily on the New Zealand dollar's appeal to international investors. In stark contrast to the New Zealand dollar's weakness, the Swiss franc is experiencing robust demand driven by its safe haven status. Global uncertainty, particularly stemming from escalating US-China trade tensions, has triggered significant capital flows into Switzerland. The real trade-weighted Swiss franc has reached all-time highs, reflecting unprecedented demand for the currency. This strength persists despite concerns from Swiss policymakers about the negative impact on exports and the broader economy. The EUR/CHF pair is also under pressure as investors within the Eurozone seek the safety of Swiss assets. This divergence between a dovish RBNZ and a Swiss franc benefiting from safe haven flows creates a powerful fundamental backdrop for continued NZD/CHF weakness. Currency strength analysis for the October 13th to 18th period reveals a clear market consensus. The Swiss franc emerged as the strongest major currency, joined by the Japanese yen and euro, as investors sought safety. On the opposite end of the spectrum, the New Zealand dollar led the weak currencies, accompanied by the Australian dollar and Canadian dollar. This divergence was so pronounced that professional Forex analysts explicitly recommended selling NZD/CHF as a high-conviction trade during this period. The strength differential between these two currencies created an ideal environment for directional trading, with the trend clearly favoring Swiss franc appreciation against the New Zealand dollar. For short-term traders operating on a 1 to 2 week time frame, we present two distinct strategies. The primary recommended strategy is a short setup with entry in the 0.4543 to 0.4557 zone, targeting 0.4510, with a stop loss at 0.4570. This offers an attractive 1 to 2 risk-reward ratio and aligns with the dominant bearish trend. For more aggressive traders willing to take counter-trend positions, a long setup becomes viable above 0.4560, targeting 0.4600 with a stop at 0.4530, providing a 1 to 1.3 risk-reward ratio. It's crucial to note that while oversold conditions may trigger a short-term bounce, the dominant trend remains firmly bearish. Any rallies should be viewed primarily as selling opportunities, rather than the start of a major reversal. Looking at the medium-term outlook of 1 to 3 months, we assign a 70% probability to the bearish scenario. This high probability outcome assumes continued global economic uncertainty, further easing from the Reserve Bank of New Zealand, and sustained safe haven demand for the Swiss franc amid persistent risk-off sentiment. Under this scenario, we target a range of 0.4400 to 0.4500, representing another 1% to 3% decline from current levels. The recommended strategy is to sell on rallies towards 0.4600, targeting the lower end of this projected range. Traders should employ strict stop-loss management and be prepared for volatility as the pair approaches these psychologically important levels. While less likely, we assign a 30% probability to a bullish scenario over the medium term. This outcome would require a significant improvement in global risk sentiment, potentially triggered by a breakthrough in US-China trade negotiations. Alternatively, a surprise hawkish shift from the Reserve Bank of New Zealand or an unexpected sharp weakening of the Swiss franc could also support this scenario. If these conditions materialize, the target range would be 0.4700 to 0.4800. However, traders should wait for confirmed trend reversal above 0.4600 before considering long positions. The critical level to watch is a break below 0.4500, which would invalidate the bullish scenario and likely open the door to accelerated decline towards 0.4400 and potentially lower. Trading NZD/CHF in the current environment requires careful attention to risk management. Upside risks that could trigger a sharp reversal include a US-China trade deal breakthrough, coordinated central bank intervention to weaken safe haven currencies, a sudden improvement in global economic outlook, or a hawkish surprise from the RBNZ. Conversely, downside risks include geopolitical escalation intensifying safe haven flows, faster than expected global economic slowdown, more dovish RBNZ policy, or a break below 0.4500 triggering stop-loss cascades. To navigate these risks, traders must use strict stop-loss orders on every trade, adjust position sizing for the current volatility and low price levels, closely monitor RBNZ and SNB communications, and remain flexible to adapt strategies as risk sentiment shifts. Let's summarize the key takeaways from our analysis. First, the dominant trend is clearly bearish, driven by the Reserve Bank of New Zealand's dovish policy stance and the Swiss franc's safe haven demand amid global uncertainty. Second, from a technical perspective, the pair is deeply oversold near 52-week lows of 0.4502 to 0.4530, with the RSI at 20.19 and Stochastic at 6.68, suggesting extreme selling pressure. Third, in the short term, while there's potential for a corrective bounce, the recommended strategy is to sell rallies towards the 0.4543 to 0.4557 zone, targeting 0.4510. These three factors form the foundation of our bearish outlook and trading approach. Continuing our key takeaways, the fourth point focuses on the medium-term outlook. We're targeting 0.4400 if the critical 0.4500 support level breaks, with a 70% probability assigned to the continued bearish scenario. Fifth and finally, risk management is absolutely critical in this volatile environment. Traders must use strict stop-loss orders, monitor central bank communications from both the RBNZ and SNB closely, and adjust position sizing to account for the heightened volatility and low absolute price levels. Remember, wait for clear signals before entering new positions in this volatile pair. Don't chase the market and always prioritize capital preservation over potential profits. Thank you for watching this analysis, and trade safely.